And number four is you have figured out which lender you're going with. You are now at the application stage and the picking of loans stage, and you are financing with must haves in mind. Let me break down what that means. I have shared that I don't think there is ever a bad time to buy a home, but I've also shared that it's always a bad time to buy a home that you can't afford. And when I say it's a bad time to buy a home that you can't afford, I have to make sure that you understand you have to be able to afford the loan all the way through. And it can't be a situation where you're like pigeonholing these 10 or 11 perfect scenarios that have to be in place in order for you to not be in trouble financially. Oh, as long as my income stays at this level and I get my bonus every year. Oh, as long as my student loan doesn't go up. That's what I mean by not really being in a position to afford the home. You're only in a position to afford it if everything goes right. And that actually can go farther out than just your budget and into the category of the type of loan that you choose. So, for example, we've done an episode on this podcast about adjustable rate mortgages, where you get a mortgage that has a lower interest rate and it's a fixed rate for a set period of time. And I'll have people who will get into this type of loan and they can afford the property as long as it's during the fixed rate period, but they don't have a strategy for what's going to occur if that rate increases after the fixed period ends. And to be clear, one strategy that people will hope for is, hey, during that fixed rate period, maybe interest rates for mortgages in general will come down and I can just refinance. I'm all for that strategy as long as you have prepared for the worst case scenario, which is what if they don't come down? If they don't come down and that fixed rate period ends, are we going to be able to afford the rate with which we're left? If that's the case, go for that strategy. Get the fixed rate and hope that the rates will go down and you can refinance before it ends. And even if it doesn't, you're not in a terrible scenario because you've planned for the alternative. But if you're getting into that loan and you know you can't afford the rate after the fixed rate period ends, then now you're saying that rates have to go down during that period. And that's not a scenario in which I would want you. You also see this with another type of strategy, which we'll talk about on the webinar, which is a 3-2-1 buy down. And the way that a 3-2-1 buy down works is actually pretty simple once you think it through. Essentially, what happens is you have a 3-year period where you're paying less than the actual fixed rate on the loan. In year one, you're paying 3% less than the fixed rate. So if you have a 7% rate, in year one, you're paying 4%. In year two, you're paying 2% less than the fixed rate. So if it's a 7% rate, in year two, you're paying 5%. In year three, you guessed it, you're paying 1% less than the fixed rate. For 7% rate, you're paying 6% in year three. And after the third year, you move forward with the rate of 7%. Now, I actually like these products if you can afford the rate at the end of the period because it gives you, number one, an idea of exactly what your rate will be at the end of the period as compared to an adjustable rate mortgage where it's going to be whatever rates are at that time. It also gives you a defined 3-year period where if rates happen to go down, you have the opportunity to refinance within that period, just like with an ARM loan, but in my opinion, with just a little more clarity. So to be clear, I like 3-2-1 buy downs as long as you can afford the rate at the end of the period if you're not able to refinance. But if you're doing it and you're getting into the home and you can only afford it when it's in year one and it's at that 3% less than the current rate, that's not the type of scenario that we're looking for. And it's a home buying strategy that I would avoid.